The objective, of course, is spiritual. We live, however, in a material, physical, temporal world. That's a quote from Ezra Taft Benson. He was a former Secretary of Agriculture under Ike Eisenhower. But more importantly for us, he's a former president of the Mormon Church.
The only president of the Mormon Church that I recognize is Jen Shah, and I think she's in prison.
Welcome back to the Promote Podcast, your insider guide to the money and mania of the CRE markets. I'm Hitan Zimtani.
And I'm Will Krasny.
Dude, we're officially past the 25 episode mark. It feels good, like we're a real podcast now.
Yeah, I know, except for the fact that our YouTube presence is abominable, but we're going to fix that. We're going to get these handsome mugs on YouTube.
Thank you to our listeners for all the love. It's been a really fun journey so far. All the love and occasional stick about Waltz, right?
Or Real Page.
Or Real Page. That one was good too. If you haven't, please write us a review on Apple or Spotify.
And reach out to partnerships@thepromote.com for advertising if you want to reach our entire beautiful audience of nut jobs.
Today, we're talking the Mormon real estate playbook, how they built a serious real estate portfolio, and then also, crucially, ran it like serious people. OG syndicator Grant Cardone swooping in to rescue a distressed Boca rental. And he's bringing Bitcoin to the table. And institutional LPs feel some type of way about real estate private equity's courtship of retail money. Well, I'm going to leave this one to you. Should we start with the sacred or the profane?
The profane.
All right, then it's going to be Grant Cardone. Okay, what is happening in Boca Raton?
That's a question that a lot of people ask all the time.
All the time, in a variety of reasons. We should start with just kind of who Cardone is. OG syndicator. Before we had Rise, before we had Tides or GVA, any of the Sunbelt guys, we had Grant Cardone.
So I think you're selling the man short. Before we had Andy Elliott, before we had the manipulated time guy,
Yeah.
we had Grant Cardone.
You're thinking small, bro. You're thinking small.
So Grant Cardone started off selling, he was a drug addict, he says, he was selling cars, and he basically manifested this entire real estate empire, one sucker at a time.
And it's a pretty good empire. According to Cardone Capital, nearly 20,000 investors. They've raised $1.7 billion, and it's an AUM of about $5 billion.
AUM is nebulous. He sells the equity at a markup to his investors. He used to have all the disclosures at the bottom of a page with like dark blue font and like slightly lighter blue lettering, like a lot of real scummy stuff. That said, he buys good real estate, which again, like the whole point of this is it's not hard to figure out what good real estate is. That's not investing.
Yeah.
Like the investing is trying to figure out risk reward. Anyway,
Well,
I digress.
he's mastered, I mean, this is the whole thing, right? He's mastered the distribution channel to retail, which is like the most coveted thing in all of real estate. If you have a path to your wealthy lawyer, doctor, whatever, you can be really competitive in this space.
Aura is the lowest cost of capital. First episode.
And he's got tons of aura. We got to give him that.
Say what you want about him. He's got a lot of aura.
He's very big, not only in the real estate world, but also in that broader world of entrepreneurship gurus, sales masters, etc. He runs the 10X conference. You know, everyone from Donald Trump.
Oh, wait, Lloyd Blankfein, you should be ashamed of yourself for speaking at that conference.
It's kind of a grab bag of silver-tongued devils, let's say.
It's not the manosphere. It's like slightly adjacent to it. It's like the TRT sales guru sphere.
Let's get into the deal a bit. There's a bankrupt Boca Raton rental property, about 366 units, and the sponsor was a very interesting cat by the name of Mark Gensheimer of Penn, Florida. Fairly prominent investor in those parts, and he's had quite a bit of trouble with other deals, not just the one we're going to talk about.
The golf club in Port St. Lucie, I think there's a land parcel there that also faced foreclosure. Typical Florida Boca nonsense.
The one we're going to talk about is 101 via Meisner, and he had $195 million of debt on it. Most of it was owned by Blackstone, and Blackstone moved to foreclose.
Yeah, he had a maturity default.
Yeah.
I think the issue is that he was going to have to inject a lot of capital to pay off the loan, which
Yeah, there was a pay down clause, which was pretty onerous.
he either couldn't or didn't want to do. And so what did Blackstone do here? Typical Blackstone savviness. They did a UCC foreclosure on the ownership interests of the owning entity.
And what does a UCC foreclosure do? Basically, it lets you bypass the long, sprawling court process, which can take years, right?
Exactly. It's just like cut to the chase. There's a cat and mouse game here. And, you know, these guys, like one of the things you can do is if you throw something into bankruptcy, that then can create a whole host of issues which take a long time, which Blackstone is like trying to avoid.
So Penn, Florida does this. The entity goes into bankruptcy, And then you got our guy Cardone coming in.
Stalking horse, Grant Cardone.
What is a stalking horse?
If a bank or a lender is auctioning something, they want there to be action in the auction. So they are incentivized to have people show up. If you're a stalking horse, you can agree to set the floor of the pricing. And in exchange for that, you can get some protections. You can get sometimes you can get a breakup fee if it goes if it goes away from you. But basically, what you're doing is saying, hey, like,
You're setting the minimum bid for whatever comes next.
precisely.
Okay.
And then with the hopes that it stirs more bids above that.
So there wasn't as much interest in this Boca Raton multifamily property as you might think. There was only one other really serious bidder, and it's a huge player in South Florida, really like big institutional money, a real developer, Crescent Heights, which is run by Russell, the relentless Galvin.
They have a tremendous private jet.
Will, you're so lame. You're talking about jets, doing condos and cruise ships now.
Sorry.
So Crescent Heights comes in. They offer a higher number. They wanted a longer due diligence period because the plan here was to do a condo conversion. As you know, those can be really messy, time-consuming, curveballs that can be thrown at you.
You got to do all the buyout. Like, it's really a lot of legal headaches and just execution headaches. And so this is actually like boils down pretty simply. It's like price versus certainty. So, this is something every seller deals with. And, it's, do you want the higher number, but maybe there's some risk there? Or do you want Grant Cardone, slapping it on the table with a $20 million deposit, knowing that he's got the money machine behind him and it's going to close?
And that's precisely what happens. Crescent Heights later pulled their offer. We're not sure why. And Grant Cardone comes in and wins this thing with a $235 million bid. In the restructured entity, Grant Cardone owns about 92%, and Penn Florida stays in the deal. But obviously, Grant's going to go out and do his thing after.
Grant Cardone owns 92% of this thing till the end of this sentence, basically.
He's like already got the pitch machine moving. Pretty standard in what the Cardone playbook, right? Put up the cash to close or win the deal and then syndicate out and make your fees and make your money right there.
One quick thing about certainty versus certainty in price is that this was actually really common during the boom days of 2021 and 2022.
Yeah.
People, if you're wondering, how did syndicators win all these deals? Because presumably, all the big institutions were in these bid sheets. They would throw down just massive amounts of money, like non-refundable day one, and be like, here you go. And if you're a seller, that's very compelling.
They can kind of see the back-end economics for them because of how they raise the money, all the fees that are built into their process.
If you look at acquisition fees, debt fees, management fees, asset management fees.
Success fees, 25% success fees, pretty good.
Disposition fees. Like, even before you get into the promote, divide it by the cash contributed by the sponsor into the deal. Like, a lot of these guys had negative money in the deal basically from day one. And so you're like, whatever. Like, okay. We find out that, it's built on Indian burial ground during diligence. Like, we'll just close. It's fine.
Sometimes that is better.
But here we have an extra twist that kind of elevates the story to a great promote story. What happened here?
This is a JV, not just between Penn Florida and Grant Cardone. There's a third member in there. Satoshi Nakamoto.
Oh, wow. Yes, because when this all shakes out and you have the newly reorganized entity, they disclose that they've got a nice asset in there besides the multifamily property. They've got $100 million worth of Bitcoin. What? What's going on?
Genuinely flabbergasted.
Cardone's investors are paying like an AUM fee on Bitcoin? Is it what happens?
I think that's right.
This is astonishing.
So somehow Grant's structuring this as like a call option.
Yeah.
Somehow.
What happens here is that Penn Florida has a 12-month purchase option. If the condo conversion doesn't go through, they have a 12-month purchase option to buy the property back from Cardone outright for $300 million. So he's going to make money there already. But Cardone has a call option to purchase their entire interest in the JV's remaining assets, which means the Bitcoin, for an amount equal to Penn Florida's cost basis, which means if Bitcoin appreciates in that time, Cardone gets all the upside. It's a pretty good structure for him.
Grant Cardone only does good structures for him.
I also want to shout out an amazing write-up on this deal that prompted this story from Ed Bond, who's an NPL investor. I'll link to the write-up in the show notes. It's a lot of fun, and it's like amazing forensic dive.
Yes, well done, Ed.
Ed writes the following. I was and still am skeptical of including BTC in a real estate transaction. If I want BTC exposure, I can easily buy it. I don't need Cardone to buy BTC and charge me an AUM fee. It also adds volatility to an already risky real estate deal. But for Cardone, it's a great situation.
Who doesn't love free upside?
Talk me through what it looks like if you're like over the barrel as an investor in this property and you want to stay in the action somehow. How do you end up saying yes to a structure like this?
There's two bidders, and one of them's a real shop with real chops, and is like, "Hey, it's going to take us a long time to figure out this condo deconversion. I know you're in like maturity default, so just hang out." And the other guy is like, "Here's a bunch of Bitcoin." Like, you don't really have a choice, you know? They both bid well over the amount of the debt. I mean, that was the face value. Who knows what it is, plus accrued interest, plus legal fees, whatever.
Sure.
So, I mean, they basically get a hope note on this thing. You know, they're not putting in fresh equity, and they still own 8% of it. The choice was this: give the keys back, or hope you can fancy feet long enough for Crescent Heights to do their DD and not find any material issues and close.
Right. The big takeaway for me, if you've built out a great distribution channel to retail like Grant absolutely has, then you have the ability to move really quickly in situations like this and structure things that are phenomenally good for Grant Cardone.
Totally. I mean, because he's not selling a real estate deal. He's been selling Grant Cardone. And he's got a lot of people who are like very excited about Grant Cardone.
I would have expected like a 5 million kind of Bitcoin sweetener of some kind, but this is $100 million.
It's like what you can raise for, right? If you can raise it, you can do it. And I think right now, like very clearly, people can raise money for crypto stuff.
So Grant Cardone's really fond of saying, never reduce a target. Instead, increase actions. And I think throwing Bitcoin into the mix here surely qualifies.
It actually worked out that Penn Florida stayed in the deal because had they just left, honestly, Grant Cardone was going to label them a suppressive person and the returns wouldn't have been there.
This is kind of related, right, to what we've just been talking about, which is building a retail pipeline. All the big fund managers, your Blackstones, your Brookfields, your KKRs, your blah, 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 they're all obsessed with this giant pool of retail money to be had. We've talked previously about the 401k pot of gold, $12 trillion that could be flowing some of it into private credit deals. And guess who's getting a little bit butthurt about all this action and the attention on retail?
Is it the investors?
It might be. The sovereign wealth funds, the pensions, the endowments, the insurance companies, kind of your traditional bankrollers of most CRE action have been feeling some kind of way about all this. They're saying, if you're going the retail route, are we going to get lower allocations? Are we going to lose kind of our clout in setting terms and such?
I mean, the answer is yes. If you're like, I want lower fees, I want you to make less money, I want more decision rights, and I also am going to make the sales process to get my money way harder. Like, what do you expect?
And you had said this earlier, right?
If there's two shops, they each raise $100 million, they do 18 IRR, 1.9 MOIC deal. The shop that raised the $100 million from retail investors is going to be way richer than the shop that raised the money from institutional LPs, because you can get not only just like the acquisition fees, asset management fees, maybe higher promote, lower pref, whatever, but you can get like a catch up, for instance, which is a thing in, certain institutional funds, but less so if you're raising like straight JV equity. The catch up basically works out to, if a deal does a 2.5x over 10 years, their promote ends up being about 40% of what was initially raised, right? If you don't have a catch up and you do the same return, same pref, same everything, it ends up being something like, I think like 12, 15 cents on every dollar. So it's a huge disparity.
So you can really juice your economics by going retail.
Totally.
Yeah.
And then also you can have like a longer tail on a retail deal, which means you can like play the long game and like play for whole dollars.
Just to clarify, the majority of these institutional LP deals are closed-end funds, is that right?
It depends, right? So institutional LPs will allocate dollars into a fund, a closed-end vehicle, which is 7, 10 years with 2 or 3 one-year extensions.
Mm-hmm.
But I'm also talking about an SMA account, which is just a separately managed account where they will invest directly with one LP, and they'll generally have a little buy box and a set of terms to go do certain strategies. And on those, like, you're just not getting a catch up. You're not going to get great fees. Again, ask me how I know. And all else equal, retail like makes more sense to make more money. The trick shot is that institutions had the ability to write a single check. which again, like going back to Grant Cardone, like why would these people take the deals? Because they offer certainty.
Yeah.
You know you can close.
Yeah.
You don't have to run around and like raise 1 million checks.
But I think when the pool of capital at play is so massive, you can take a few more shots because there's so much money to play with. All these big fund managers have been setting the stage for this, right? They knew that the 401k thing might be coming. They obviously lobbied pretty hard for it. And they've been setting up these relationships with the vanguards of the world.
they've been working on the distribution. And also too, yeah, you're dealing with, one group if you're trying to raise institutional money, but it's going to be how many meetings, how many months. They want to see so much from you. Like you have to put together so many materials. It again adds to the cost that like you need to have like so much full-time IR staff. You have to do things on the back end that don't add value necessarily to your investments to justify these people coming on your platform.
One of the things they're concerned about, that the institutional LPs are concerned about, the loss of co-invest. Can you talk a little bit about that, what that looks like or what that means?
Co-invest is something that sponsors liked because it allowed them to raise more money and upsize, and LPs liked because they could negotiate lower fees on those co-invest dollars. They're generally fees, but they're much lower. Again, depends on the deal, depends on the sponsor, depends on how much leverage they've got, but they will be significantly cheaper than investing like directly into the fund. And so it's a way to blend your costs down and allocate more dollars at the same time.
Let's say you're going to put 500 million into Cortland Multifamily Bonanza Fund 1, and then you're going to invest another 75 million as a co-invest.
Right, or you have the ability on certain deals to upsize your co-invest. Because the way this works is if you have a $2 billion fund, you're like, wow, that's a huge fund. I can buy $6-7 billion worth of real estate. But like, let's say you want to buy a $3 billion portfolio of industrial. Like
You can't write that check from the fund. Yeah.
yeah, you can't write a 50% of the fund
Yeah,
check.
yeah.
So, maybe you do a $300 million slug out of the fund, you do 700 million of co-invest. And so you can go raise that from the same LPs. You've already got docs for the most part, and then it's just really negotiating fees. So it's a seamless transaction basically for both groups.
There's an interesting point in the Bloomberg article. I don't know if this quite applies to real estate specifically, but it said the hurdle rate for institutional LPs is typically around 8%. But for retail evergreen funds, more and more of these things are going that route. It could be as low as 5%.
Can't necessarily speak to that firsthand, but it makes sense because if you have an evergreen fund, how do you get liquidity? So, and if you're going to be in it for a longer time, the IRR math works against you every day.
The other context here is that it's been harder and harder for fund managers to raise from institutional LPs. So Preqin had some data on private equity firms raised just under $600 billion globally for the 12 months ending June. That's the lowest haul in 7 years. So that pool of capital is shrinking, and they're fussy and demanding anyway. Why not go to these retail investors who've got a lot of money to throw at you and are obviously not grouped together in the way that they can have the same leverage?
It's been coming for a long time. And also, too, as all of these custodians have so much capital, it's not as if you have to go be Grant Cardone and build this channel yourself. You can just layer into this one API, tap the vein, and it comes rushing out.
We had talked about how if you're a RIA or a wealth manager, you're probably going to have a really good time in real estate for the next few years.
You are going to get a lot of steak dinners. You will not have an iron deficiency.
Another point that the institutional LP sounded the alarm on is if these fund managers have all this money kind of burning a hole in their pocket, they might go chase deals that they have no business chasing.
What? Never. These guys are fiduciaries.
I'm shocked to find that gambling is going on in here.
Religious institutions have always been major players in real estate. Trinity famously was gifted 215 acres by Queen Anne in the 1700s. They own a huge chunk of Hudson Square. Yeah. But I think most of the religious folks are not as good at the real estate game themselves, potentially.
They've been endowed with the land, but not so much endowed with the skills.
They have higher pursuits, Hitan.
That's true, except there is one shining exception to this rule.
The Mormon Church.
They run that shit tight. They have an incredible property portfolio.
What do they have?
It's probably a lot bigger than this, but this is, I think, as of 2020 or so, 1.7 million acres, $16 billion worth of real estate. I think it's a lot more. This is just what people have been able to find so far. And they're amazing. They buy in A-plus locations.
Obviously, the church has bought lots of farmland, spent like $300 million buying 45 or 46 farms across like 8 states. But they're buying now also discrete assets. So they bought this big rental building.
Right.
They bought another one recently. They bought a really large, like well over 1 million square foot industrial building in Hialeah in Florida too, in Q4, I think, of last year. And what's crazy is that they're doing all these deals in Florida, according to the Salt Lake Tribune. They own over 2% of Florida's landmass.
Oh, wow. What are they, BlackRock?
Yeah, right. I mean, like, that's a staggering number. Like, Florida's a pretty big place.
That's an astonishing whole. Yeah, it's pretty damn big.
Yeah, they've got a huge ranch in Central Florida as well. They have a forest property in the Panhandle. I didn't know there were forests there, but apparently.
Who are they competing with? Stefan Soloviev?
Stefan Soloviev, John Malone, and a couple others. But I mean, they're one of the largest landowners. And again, which makes sense if you have like a super, super long-term trajectory. But now they're buying multifamily too. So they paid $400 a unit for a massive deal in Boca. Also in Boca. The 384-unit Del Ola apartment complex from Clarion and Cortland for $152 million. Again, that's all equity.
They don't use any leverage. And how have they created this perpetual capital vehicle? It's a pretty good story.
Tithing.
Tithing. What is tithing, Will?
I certainly don't do it, but it's you donate 10% of your income to the church.
For good works and such. Tithing has created this absolute behemoth, and it's called Ensign Peak. Ensign Peak is the endowment for the Latter-day Saints Church. And I think it was insanely well run. It was $40 billion worth of AUM in 2012. And by 2019, that number had jumped to $100 billion.
Also consider there's some very wealthy Mormons. So that's a lot of tithing.
Yeah.
It's just so much money coming in as well. Like that's the part that's staggering. They have to put, all this money to work, but there's no pressure because you don't have to worry about liquidity. They're not worrying about, well, gosh, my growth PE allocation hasn't returned capital.
I spoke to like a former Mormon guy and who knows who's connected to all the property reserve people. They truly believe that they're building for the second coming. So their entire real estate strategy is informed by that very, very long-term approach, mindset.
Honestly, it's a really good approach for real estate.
And they're good, dude. They have everything down to a science. So their floor plans are really templated. If you look at the Mormon buildings, they're all like, they're all set up really nicely. The Mormon real estate unit is called Property Reserve, and it's run by a guy called Ashley Powell. What do we know of Ashley?
Ashley's a real guy.
He's a real guy.
Yeah. So he was at Deutsche Bank, Bentel Green Oak.
But you know what I love about him? I went on his LinkedIn today. His LinkedIn says nothing about those. It's all about the church. There's no mention of those two like pedigreed positions.
I mean, this guy went to BYU and then came back to be director of acquisitions in 2017.
Do you see what he studied? It's almost like he was setting himself up for this from the very beginning.
Construction management.
Construction? What kind of degree is construction management?
It's a very useful one for real estate, to be quite honest. So this guy's he's a developer. I mean, again, you own all this land, like, and they're building stuff for the long term. Like, you don't want just, a spreadsheet monkey who can, juice an IRR or what have you. You're really building stuff over like long term. Like we talk about master plans. We talked about Starwood buying one that took, we're like, oh, it's going to take 10 years. This is going to take 100 years. How long is it going to take to build on 1 million acres of farmland?
Need a little bit of divine patience, I guess.
Yeah. And I mean, they've got a 200-person team.
Wow.
At Property Reserve. I mean, that's like pretty serious.
And what's interesting? It's like people aren't blowing smoke. Like I've talked to ex-Mormons and current Mormons about this. To a man, they've all said, like, these guys know what they're doing when they're building. You ever done deals with the Mormons? Well,
I've not done deals with the Mormons. I've done deals with other religious institutions who did not know what they were doing, much to my benefit. There's a whole sect of like Mormon investing and Mormon returns both in private equity and business that have been very, very successful. One of the reasons why Real Housewives of Salt Lake City is such a phenomenon is because everyone's incredibly wealthy on there, except for the aforementioned Jen Shah, who is in jail.
I hold myself to a high standard. If you don't want the same standards, go away.
It's this whole ethic. We talked about it previously with the Patels in the hotel industry. It's just not just money making, but just like, as you said, hard work, success, craftsmanship, doing things by hand, doing it the hard way.
And I think sales is kind of woven into the DNA, right? Because you start as a missionary, you go to these foreign lands and you're preaching the good book and you understand what rejection means, you understand how to close.
Coffee's for closers only. You think I'm fucking with you?
Right? And then it translates. These are the kind of groups that there's so much going on behind the scenes, beneath the surface, what have you. I think we only found out how big Ensign Peak was because of a whistleblower who went to one of the big papers in Utah. But my God, they probably got some, I don't know if they JV with anyone, if they're quiet backers of anyone. There's probably a lot more.
I think so. But having the size and the scale that they do, they have a very real guy as the CEO. They have 200 investment professionals, or who knows how they're split between back office, front office.
Back office, front office, all roads lead to God. Well,
what's interesting too is again, looking at Property Reserve's like mission statement, everyone, we've all read 1,000 of these. It's like, we work for our investors. We strive to achieve, risk-adjusted returns, based on our economic analysis.
Well, some people go really far and they say stuff like the Roman Empire and stuff. I read you a couple of those too. Those are
those are amazing.
Yeah.
This is what Property Reserve's mission statement is. As caretakers of sacred funds, we invest in responsible, reliable, and revenue-generating properties to support the church's mission. With a focus on creating sustainable cash flow, we grow the real estate investment reserves of the church to the acquisition, build to hold development, and management of domestic international properties.
And they really mean it.
And they mean every word.
We know that the Mormon church doesn't really mess with debt, but do you think they'll ever get into Bitcoin?
I don't think I can see the Mormons and the Scientologists getting together and letting Grant Cardone add in Bitcoin to these real estate deals.
You're thinking small, bro. You're thinking small.
That's it for the Promote Podcast this week. We'll be back next week with more CRE Insider goodness.
Write us a review on Apple or Spotify. Tell people about us with the zeal of an LDS church elder.
Absolutely. Preach this podcast to everyone in your life, and we'll see you back here next week. Ciao.